Hi, rabbits. Research Turtle here. Today, we are diving deep into the nuclear option of monetary policy. You've heard of printing money, but what happens when central banks stop trying to control the quantity of money and decide to fix the price of money instead? We're talking about yield curve control, or YCC. Let's walk through the charts. Look at page 2. For years, the old paradigm was quantitative easing, QE. Think of QE like that bucket of water. Central banks poured liquidity into the market to lower rates. But there was a limit. By 2016, especially in Japan, they were running out of bonds to buy. They hit a wall. So they flipped the script. Instead of saying, we will buy X amount of bonds, they said, we'll keep the 10-year yield at 0% no matter what. Under QE, the volume is fixed, but the price floats. Under YCC, the price is fixed and the volume floats. How do they actually pull this off? Look at page 3. It's a magic trick based on credibility. If the market believes the central bank will buy unlimited bonds at 0%, nobody will sell for less. The central bank might not have to buy anything at all. It compresses the term premium, the reward for holding long-term debt, down to nothing. It's a costly commitment, though. Once you start, you can't stop without pain. Is this new? No. Page 4 takes us back to the 1940s. The U.S. Fed used YCC to finance World War II. They pegged T-bills at 3.75% and the long bond at 2.5%. It worked beautifully until the war ended and inflation returned. The lesson from 1951 is clear. YCC works during a crisis, but it breaks when inflation comes back. Now fast forward to Japan, page 5. The Bank of Japan adopted YCC in September 2016. Here's the irony. They did it to buy fewer bonds, not more. Look at the gray bars dropping. This is stealth tapering. By setting a price target, they let the market do the work, drastically reducing their purchases while keeping rates pinned at 0. But pressure builds. Page 6 shows the slow retreat. Japan started with a tight band of plus or minus 0.1%. Over 8 years, global inflation forced them to widen that band to 0.2%, then 0.5%, and finally to a reference of 1% in 2023. They were fighting a defensive war, retreating inch by inch to avoid the dam breaking. Speaking of dams breaking, let's look at Australia on pages 7 and 8. The Reserve Bank of Australia tried to peg the 3-year yield at 0.1%. But unlike Japan, they were rigid. When inflation spiked in late 2021, the market attacked. The RBA capitulated and the peg snapped. The result was a disorderly exit and massive reputational damage. The lesson is on page 8. You need to be the bamboo that bends, like Japan, not the oak that breaks, like Australia. So what is the cost of this control? Page 9 shows the kink. When you manipulate one part of the yield curve, you break the market. You get liquidity evaporation, days where zero trades happen. And on page 10, we see the pressure valve. If you lock rates at 0% while the US is hiking to 5%, the pressure has to go somewhere. It goes to the currency. The yen collapsed because capital fled to higher yields abroad. This brings us to the global risk on page 11. Japan has been the world's creditor, but as YCC ends and Japanese rates rise, that money is coming home. This is the Great Repatriation. It's a strategic verdict, page 12. YCC is a Faustian bargain. It gives you certainty and fiscal synergy today, but destroys market function and currency value tomorrow. So, rabbits, what's the takeaway? YCC is an emergency brake, not a steering wheel. It belongs in the toolkit for pandemics and wars, not for normal times. As the anchor lifts, the floor for global rates is rising. The era of free money is officially over. That's it for today. Turtle out.